What's up, everybody? Welcome back to Earn It, Save and Invest It. In this video, I'm going to break down why I think HIMS is a buy, why I think it can reach over $125 per share. So I'm going to go over the numbers. I am a shareholder, so I'm going to go over the numbers, why I think the share price can go over $100 to $125, and yeah, just kind of break that down really quickly. So if you can, please give a like and subscribe. I really appreciate it for everyone who does like and subscribe. And we're just going to get into the numbers right now. So this is my $100,000 challenge. HIMS is my second biggest holding at almost 16%, $1,400 worth. I have 45 shares. My cost basis is $24.13. I started my $100,000 challenge when HIMS was almost at like 60. So it really has hurt my my whole $100,000 challenge, but I do believe it's going to come back. So I'm going to explain exactly why. So HIMS right now, its market cap is 7.1 billion. Share price is 31.38. The EPS is 48 cents, and the forward PE is 65. Now, 65 forward PE for a stock on just a regular stock is high, but for a stock that is growing as fast as HIMS is growing in terms of revenue and profit, a high PE it is warranted. So it will command a high PE. This is a number that's interesting though. It has a 30% short interest. 30% of the shares are shorted. That's pretty insane. So we're going to kind of go over that as well. This is, some analysts and, whatever. An analyst is there's all kind of analysts out there, right? But we have a hold, buy, strong buy, buy, hold, buy, right? So no sells or anything like that. This is their seasonality. As you can tell, HIMS is very volatile. I really got to zoom out to get it all, huh? You can see like December 50s, November's the best, 71%. So, if you just look at the individual months, we have almost consistent double digits, right? You have just last year, 25, 20, 34, 12, 70, 12, basically 32, 36, 33, 20, 12, and 18. Every single month, the lowest was 12%. We have 12, 12, and 12, right? Whether it was positive or negative. Then we had a plus 50% and a plus 70% and a minus 36%. This stock is all over the place. So just be aware of that. So I would not expect 2026 to be any different. You look at 2024, it also had a lot of big ones. It did have a 2 and a 5 and a 4. It was definitely a lot calmer in 2024. But I would expect 2026 to have a kind of the same theme of, double digits. In terms of every month moving a double digits. The revenue moving up, right? The revenue is clearly moving up. This is, of course, estimated, right? This is what they estimate the revenue is going to be at the end of 2026, 2.76 billion. Earnings, it was going up, and then it dropped the last 2 quarters. They've had a few issues, but that should be resolved now. So they're estimating that trend to kind of now move back forward and going up. Again, their earnings, they expect the year over year, not too well. Again, 2025 wasn't the best. And if we look at actually, right, and over the last year, it's only up 12%. 12%, right? Month, we're at minus 13%. But for the year, I guess year to date, that would be January. We're minus, 3%. But for 1 year, it's 12%. And this is, again, January, mid-January. So for a whole year, right? Almost the whole year, it was going up so much, and it ended up only 12%, basically, right? So the earnings, they think that the earnings are going to continue to rise and rise and rise. I'm going to go over that a little bit more. Their growth, the revenue, 78% year over year. If you look at the 3-year CAGR, which is compounded annual growth rate, 70%. So over the last 3 years, it's basically grown 70% on a CAGR, which is pretty good. That is really good. So that is why it commands a 65 PE. or even more, right? Could even more. Now I'm going to explain why it could have a PE of less than 65 and still be a higher price than what it is today. The gross profit margin is 75, but the net income is 6. Regardless, it's still a profitable company. And then quickly to go over one thing that does kind of concern me is that individuals, insiders, they do hold almost 10% of the company. Now remember, 30% of the shares are shorted, right? I mean, it says right here, short interest, 30%, shares short, 67 million shares are shorted. You know, I mean, that has to be out of the institutions, right? I mean, that would be all individual, that would be everybody else, absolutely everybody else. You know, the institutions are shorting the living out of this, right? So, because the institutions hold 90%, but again, still insiders, right? They hold 10%. It's like not as much as like the public, and you know, it's the insiders. So that's a little concerning in a way where they have control of it. But nonetheless, again, it's still a 30% shorted company. So income statement, balance sheet, cash flow. I can kind of go over all this right now, but I'm not going to go over this because this is what they've done right now. I'm going to show kind of what they're going to be doing in the future. So earnings, let's go to the estimates. Now, there's one thing I want to have you look at really quick. It says this was their last earnings, right? Third quarter 2025. It says, when we first shared our 2030 goals of at least 6.5 billion in revenue and 1.3 billion in adjusted EBITDA, it was with this clear vision in mind to redefine what modern healthcare can look for consumers everywhere. Today we're delivering on that vision, and real world opportunities to accelerate our trajectory are materializing quicker than expected, and we're leaning in. What I really want to focus is 2030 goals, 6.5 billion, materializing quicker than expected. Today we're delivering on that vision in a real way, right? So it looks like the 2030 goals of reaching 6.5, and it's, even though it does seem like a long way, really it's only, you know, about 4 or 5 years away. So that's not that far away. So if we look at the earnings and we look at the revenue estimates of what they think they're going to be having by they don't even have 2034. So, you know, obviously it's just one analyst, and then we have two, and we have a few by 2030. But the fact is that you know, you look at the year-over-year growth, 58% in 2025 on a bad year. Now, what about this year? They really think that it's going to not grow that much? Now, you have to understand, if they beat these analysts' expectations, if they beat the expectations and beat it like significantly, that's just gonna help the stock price a lot, right? The revenue, this is the EPS, right? So they have it 48 cents, and obviously they have the year-over-year growth growing a lot more for the EPS up to 2030, right? A lot more. Interesting, but right. So they have, and if we look at that, we take 48 cents and we grow it to 191. Right, over, if we go 1, 2, 3, 4, 5 year basis, right? Take 48 cents over 5 years. You need a 31.75% rate of return. This is a compound interest calculator to get to 191, right? So they're expecting the earnings per share to grow around 31.75 on a compounded annual rate, right? Now, if you look at these numbers, you could say, yeah, that actually kind of matches up, right? You look at a 31, a 30, like all of these 5 years, yeah, that seems like right? Now, we look at the revenue. Oops. We have 2.35 growing to 4.18. That's 12.2%, right? They're going to be growing a lot faster than that. They're going to be growing somewhere around there, right? 6 billion. So they're around the 20%. That's almost 10% higher than what analysts are expecting. So that's that's something to keep in mind, that when they go in there and they beat expectations, that's going to just push the share price a lot more. And I think they're underestimating what HIMS is going to be doing. If you look at their financials, it's been growing significantly every single year. Even when they had a year that wasn't the best, that still was growing, right? You look at their net income, growing. Right now, they're actual profitable company. So, and you'd like to see the profit grow a little bit more. But again, this was still not the best year for HIMS. If we look at their balance sheet really quick, they have cash and cash equivalents, $345 million. And in total assets, they have $2.2 billion. And in liabilities, 1.6, right? So they have more assets than liabilities. They have 581 million more. So that's obviously good. And then the cash flow, net change in cash, is continuing to go up, right? They're repurchasing their stock. So that's also a good thing too, is that's going to help the earnings per share go up. They are repurchasing the stock, and they're buying companies. So if you look at how much, this is a great website to look up, totalrealreturns.com, and I looked up HIMS, and it just started from their IPO basically, right? Where this is where it really was. It didn't do anything for the first while, which is actually kind of funny. The overall return and per year, it is including all of this first year of really doing nothing, right? The first year of doing nothing. And yet you're still getting a 220% return, about 20% per year, on this. So, HIMS is it's gone up and down, up and down. It's gone up and down a lot. Right now we've been stuck in this range, right? This is where it's really been stuck this whole year. It pushed all the way almost to 70 basically, and then now we're at about 30. If you look at it though, the exponential trend line, it's trending towards 27% per year, right? That is what the trend line is doing. Now, that's good, and that's obviously including, we're including this first year, right, or so, and that's, even more than the first year, which makes it even worse, I would say, right, in terms of time, because it looks like it did a whole year of nothing, right, 2019, just 1%, right, and then it went 47, 55, minus 2 in 2022, which is kind of crazy. Plus 38, plus 171, plus 34 right now, year to date, minus 3. So, HIMS, if you did have $10,000 of it at IPO, you'd have 32. Obviously, not a whole lot, like in terms of, of other opportunities you might have had at that time, but still, it is I think it's only like that because, we're at 30. It's going to continue to go up. So, that being said, I do believe, let me get this. This is HIMS. I do believe that this is a good time to buy. This is a good time to buy. I put this box here because I said this would be a good time, and I mean, I don't care if I have to stretch this thing out. If you are buying anything under 40, that's a buy. Right now, because let me kind of go over why I think it's going to go to 125. So they have the earnings growing, obviously a lot smaller, right? So we have a 21% return on what we actually think the revenue is going to be, right? The earnings are going to be better. So if they really think that the it's going to grow that much. So if we take, let's go here. What is it? At $31 in 5 years, 21%. It's going to grow, right? It's the trend line is going at 27%, right? Right here. Trend line 27%. It's at $31 over the next 5 years, 27%, $102. Now, it could go even more. Now, imagine this. Imagine if you had, it's going up 27%. So let's say you invested $1,000. It goes up 27%. This is how much you would have. But if you just invested $100 a month, it goes up to that. Now, granted, you're investing more, but you get a lot more to it. So HIMS does have a chance to get to $100. I believe so. Give a like and subscribe, please, if you're still watching. Over the next 5 years, if it does grow at what the trend line is saying, and as well as just what the revenue is probably going to be. They think right now they're on the path to making $6+ billion per year by 2030. The analysts, again, there's just a few, but they have it at 4.18, right? So they are not expecting HIMS to perform as well as HIMS is expecting to perform. So I like that. And so I would say HIMS is a buy. $31 right now. It's mid-January, so who knows exactly whenever you're watching this, but I do believe it is a buy, and I do think it will return really. So if we look at the returns of what it could, right? If it was 27%, right? If it's 27%, let's say you have $1,000 and you save and you do the 27% over 20 years. Now look at it, right? It's definitely different. Now, obviously, you want to make sure that, most stocks are not going to grow 27% on average for 20 years. That's just not typically going to happen. So let's just, put this at like a 20%, and then you put in $50 a month. You have $150,000. You saved it. You have $1,000 that you invested, and you have 20 years to save, and you're getting a 20% return. You find some stocks every 4 or 5 years. You find some stocks that, they're looking like they're going to be good, and they can get you a 20% return. You invest $50, just $50 per month. I do $50 per week. You do $50 per month. I mean, if I'm doing the same thing, if I have that, but I'm doing 200, I could have that in 20 years. And I started with this much, so I'm hoping to have at least that much, and I'm hoping my rate of return is that now. But yeah, if you can get a 20% return, and you're putting $50 a month, and you start off with $1,000, you're looking at $150,000, and that's pretty good for just finding a good stock and finding just good businesses. So I do believe HIMS can be that business. Be that business that does well for your portfolio, especially right now. It's at $30. If you saw how just look at this trend line. Well, look at where it's been going. Right, it's been going down, 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 but the business hasn't. The numbers have not been going down. Right. Let's look at the actual, if we look at the financials, let's go to earnings history, revenue, right? It's going up every year. Look at that revenue. Look at that. That's amazing revenue. It's not going down at all. And yet, again, granted, it's shorted. It is shorted, right? It is a shorted stock. And the PE was a little high, especially when it was at 70, when it was way up here. I get that. But I also believe that this was just a bad year for him. So over the next 5 years, this thing is going to be performing, in my opinion, performing very well, giving you at least a 20% return probably, because if you take what am I doing here? You take 31 for the next 5 years, 20 right? Oops. Yeah, 27%, right? You're getting $102. So I think this thing can really perform well for your portfolio. If you have the gut for volatility, this stock does go up and down very heavily. So just be prepared for that. So yeah, that's my 2 cents. Be aware, be prepared, but don't be scared of the stock market. It definitely gets emotional, but if you do it right, you could end up getting a lot of money. So anyways, thank you for watching. I appreciate everybody. And don't forget to earn it, save it, invest it, buy low, sell high. I want assets, not liabilities, and you can count on compounded interest.